Hello students, I am Priyanka Srivastav. I am your mentor, and today we are going to start with the topic time value of money under financial management. So before starting with time value of money, let us understand that the concept of financial decision. Basically all the chapters that we're going to study under financial management will basically depend on the reason of studying all these chapters, all these concepts is we want to learn that is how to take a financial decision. So to take a financial decision, first we need to know the reason, that is the object that is for which the finance is basically raised. So what is the financial decision? It means taking decision with respect to raising money. That is from where you can procure the fund. We have already discussed in the previous class that we'll need to find out procurement of funds. That is from where you can raise the fund, what will be your source of finance, and second, how you can do the effective utilization of the fund. So basically, keeping in mind these two main things, we're going to discuss the different methods that we have in our syllabus with respect to the financial decisions that can be taken, that will going to help you in taking the financial decision. So what is the objective of taking financial decision? Write it down. I'm going to dictate it. So the objective is to know that from where a company should procure funds in order to finance an investment project. What do we mean by this? Basically, if we have some investment project, that is a project in which we need to invest, or we need to invest some funds, or we need to run or set up a project, for that an investment is required. So basically, from where we're going to raise those funds to invest in that particular project is basically what the financial decision means. And now you can pause it and note it, okay? Next is basically the steps, that is steps to take the financial decision. So we're going to discuss certain steps. So there are basically 3 steps which will help us in ascertaining or in taking the financial decision. So first step is basically we need to find out the various sources of finance from where the funds can be raised. So basically first step is source of finance. So this is a chapter that we have to discuss, source of finance. So that will going to give the answer, that is from where funds can be raised. This answer to this question will be given in this chapter. Second is to evaluate every different available source of finance. So suppose there are 2 sources of finance, debt and equity. to be very honest. We all know these two. Okay, so we're going to evaluate the different available source of finance in terms of two things: cost and risk. Now, to ascertain the cost of capital, we're going to discuss. We'll be seeing a chapter named Cost of Capital. Okay, and to ascertain risk, we have a chapter called Leverage Analysis. Okay. Now, you can note this down. Okay. Now, what do you mean by the word leverage analysis? Leverage analysis means we're going to evaluate the risk associated with the source of finance that we want to choose. So, suppose if we are choosing debt, the obligation or the risk it has with it is interest. So there is an interest obligation. And in case of equity, so if you are like investing in shares or you are an investor and you are investing in your debt market, for you the interest is your safety, and in case of equity, dividends are uncertain. Okay, and the share prices are also uncertain. So that is the risk for the investor. But if I am a company, for me, the debt will be the more risky thing, because there is an interest obligation. Even if I'm having a profit or I'm having a losses, then also I need to pay those interest obligations. Okay, and if I'm in a company and I have an issued equity, so obviously it's interest free, so in that way it will be less risky. But if I issue equity to more than 51% in public, so there might be a chances that other person might do the takeover of my company. So basically, the risk is involved in every source of finance. Leverage analysis is going to help us in evaluating the measurement of that risk, which is involved with each of the source of finance, and then we'll compare them, that which will going to give us more cost or less cost, or which will be more risky or less risky. And by comparing all these things, we can basically come to a conclusion that which source of finance we need to choose for raising the funds. Okay, so let us write something. It says, for leverage analysis, it says basically risk also means obligations that is, if return of money borrowed is an obligation for borrower. What do you mean by this? Here it is an example. So basically, if I'm talking for the company, the debt is an obligation also for the interest thing, plus we need to do the repayment of that debt after a certain time, and equity needs not required to be repaid till the winding up of the company. So this is like a pros and cons of each and everything. Now we're going to understand the prospect of two people. First, risk as per two people's prospectus. One from borrower prospects, other from shareholders prospects. So if I talk about borrower's prospect, we have two things. If we choose the source of finance as debt or as equity, so debt will be more risky because we have obligations. Obligations of what? To pay interest and for repayment. Okay. And so that is borrower's prospect, means company's prospect. So, and if I am issuing equity, then this is risk-free because no interest and no repayment. Okay. Now next is shareholders prospects. Again, if they are going for debt, it will be less risky for them. Reason? They'll get what they will get. They will get interest. They will get short repayment. Okay. Next is if they go for equity, then it is more risky. Now what is the reason for this? They might get, okay, dividend, because it's not compulsory for the company to pay the dividend. It is on the company. If they have profit, they can distribute dividend. And even if they have profit, they have the right to retain those profit for future prospects. So it's like not a compulsion on the company. So it's like more risky for shareholders because they might not get the dividend, or you can say return on those equity. Second is no repayment. But it can be saleable in the market, but again fluctuation in price. Okay. So these are the, like you can say, the broad points from both point of view, like from investor point of view and from like company's point of view, that if they go for either of the option, that what risk they will have. Okay. So now I'm making the screen big and you can note this down, pause it and note it. Now what you will be thinking by listening to this fact, that what will be the more risky, what will be the less risky. By understanding these things, you might be thinking that company will always want to go for equity and investor will always going to go for debt. So is it possible, or is it like just that only one thing is in my favor, so I will go for with that only? So the company will not run like this. Company need to have an optimum combination. Optimum combination of debt and equity. This is required. You might have studied in your accounts, in your ratios or something. You can pause it and note it. I'm changing the screen. Okay. What I was saying is this is a company. Okay. Now, the source of finance, or you can say a balance sheet of company, will always contain equity and might also contain debt. And the ideal balance sheet that we have need to have an optimum combination of these two. The ideal combination that we have studied in our foundation or in our school 11, 12 is 2:1. That is debt is to equity is 2:1. That is, if my equity is 1 lakh, then my debt can be of maximum up to 2 lakh. So this is my ideal combination. Okay, ideal combination. Now, what is the reason behind it? So, for that, you need to write down first. Okay, first write it down, then I'll explain it to you. Let us write it down. Question we have is why we opt for a combination of debt and equity. Answer we have is debt is cheaper and equity is risk-free. Therefore, company forms a combination of these two in the company to keep the optimization, or you can say to keep the optimal capital and its debt equity mix. I think some of the students might have understood. For others who don't have understood or who are not clear with this, I'm going to explain you with an example. Okay, you can pause it and note it. Okay, basically we were saying that we have two criteria, cost and risk. So if I talk about debt, this is less costly for the company. Reason, they'll get tax deduction. It will reduce the profit. Okay, so that will help you in basically like how we'll calculate this. We have earning before interest and tax, then we can reduce interest, then we have earning before tax, and now we will charge tax on this amount. Okay, so basically it will basically reduce your profit, reduce your tax burden, so it is less costly, but it is more risky. Why? Because it gives the obligations to pay the interest, to repay the loan or repay the debt. So that is an like more risky thing for the company. Now, if I talk about equity, cost is more. Why? Because when you basically, if you want to pay the dividend will be coming after earning after tax. Out of this, you are going to pay the dividend, and dividend will not be treated as expense. It will not be treated as expense in profit and loss account. So basically, it will not give you the tax reduction. So that's why it is more costly. Okay, and it is less risky. Why? Because we have no obligation. Okay, so we have no obligation. So we to have an ideal situation, that is, we want an optimum risk and optimum cost. So to maintain this equation, we need to have an optimum combination of debt and equity in our balance sheet. So the debt should be twice, should not be more than twice of the equity that we have. This is the ideal ratio or ideal situations that we have. Okay. So that is the main concept of this. Now I'm giving you a minute. You can basically read this and go through this. And to be very honest, 2:1 isn't just a general ratio, but the ratio that is basically best for your organization, for your capital structure. For that, we need to go through a topic which is known as capital structure. So this is what the step 3 we have. Step 3 we have is basically to find out optimum capital structure on the basis of debt equity mix. Now this answer we're going to get in the chapter capital structure. So by understanding all these 3 steps, what we have find out is basically first we'll find out the source of finance. Then we'll basically evaluate the source of finance. Then we have find out optimum capital structure consisting of the debt equity mix. So all those topics that we're going to discuss after this lecture will basically contain the true meaning of capital structure, or basically we're going to understand that how we're going to take the financial decision one by one, and the other chapter, all these chapters will collectively help you in taking those financial decisions in a better way. Whenever you're going to work in an organization, whenever a question comes like we need to make it or buy it, we need to invest some money, or we need to invest in a particular project. So in all those areas, in all those situations, you need to take a financial decision, and these methods are going to help you in taking those decisions. So right now I'm ending this video here only, because this video will be completely for you can say financial decision, and in the next video I'm going to start straight away with time value of money. So please revise this basic before going towards next lecture. Okay, thank you.